My name is Nick, and I'm going to be doing an introduction to IPOs. So how much money is a lot of money for a company to raise money?
$1 billion.
Try $20 billion. That's how much the Commercial and Industrial Bank of China raised on its opening day in the Chinese market. So I'm a business major student. I've always been interested in corporate structure, and I've done a lot of research about IPOs. And IPOs are really relevant to you because either now or at some point in the future, you guys will own stocks, you'll own funds, you'll own bonds. Those are all affected by the markets, and IPOs have a big effect on the markets. Okay, so my thesis slide just got deleted somehow, but I will be talking about how a company goes through an IPO, what are the advantages and disadvantages of an IPO, and some IPOs that were really successful and others that kind of failed. So, what is an IPO? An IPO is the first sale of stock by a company to the public. That's according to Investopedia. So the public is stock markets like the New York Stock Exchange, the Dow Jones, or that's a type of fund, but the NASDAQ. Those are all markets. There's also many, many markets on foreign exchanges. So where does a company begin if it wants to go public? Well, first is to stack the roster, to get a team of people that know what they're doing and have a lot of experience. It's a very complex process, and having people that know what they're doing is really critical to having a successful IPO. And preparing the accounting takes several years. There's lots of regulations and rules that need to be met, and having people that know what they're doing is really critical. The last step is to find a good investment bank, because an investment bank not only helps the company find or prepare the documentation, they also help them register with the SEC and prepare this prospectus. And then they also help the company find potential investors, which is the biggest part in an IPO. And that's according to Investopedia. So the investment bank helps register with the SEC, which is the Securities and Exchange Commission, and this is the government body that regulates all publicly traded companies. There's lots of accounting rules and regulations that they set that have to be met, and if you don't, you can get in a lot of trouble or go to jail like some people have. The investment bank are typically big names like Morgan Stanley, JP Morgan, Goldman Sachs. Occasionally they're smaller, but these are typically the big ones because, again, they have lots of experience and they know what they're doing with IPOs. So after the company has teamed up with an investment bank and start preparing documentation, they go on a roadshow. This is when they travel around to lots of different financial centers like New York and San Francisco, hyping up their company and like trying to sell their product to investors. Or not necessarily the product, but their company. And it's only after the roadshow that the prospectus is released to all investors. Now, the prospectus is a large document developed over the past couple of years with the lawyers, the accountants, the bankers, and it's really the only piece of material that investors have on the company. Because before it was private, so none of the information was released. And it's information like, salaries of the executives, certain problems that the company may be facing, lots on earnings, stuff like that. It's a very detailed document. However, unless you attended the roadshow events, you won't have as much information as those did. So after the roadshow, after the tour, they will try and value the company. Now this is really important because after you value the company, then you can determine how much stock you're going to sell and at what price, which is clearly the most important part of the stock is how much does it cost, what's the value of it. So on big day, the IPO is typically announced after the market closes and then trading begins the next day. So that way people have some time to think about it, learn some more, just have a little bit extra time. The investment bank will typically take about 15% of the price as its earnings, as its profits, for doing all the hard work and helping them determine or just go through the IPO process. And then hopefully, if everything goes out well, they'll raise a lot of money, they'll sell all the stock, and it'll be a successful IPO. So what are some of the advantages of going public? Well, you can raise a huge amount of money in just a very short amount of time. This can help you pay off debts or expand market share. in addition, all the publicity around it also attracts buyers to your company and just helps you establish your brand even further. It's also an opportunity for owners to sell off part of the company, and so they're not as heavily invested in the company. And further, because they follow all the SEC regulations and they're much more straightforward and regulated, it's easier for them to borrow money in the future because people know about the company. It's not just some random company that no one knows about. So some of the disadvantages is it's expensive. It's a one-time opportunity, so if you mess it up, you're done. You're also subject to the markets, which go up and down on a regular basis, and that can really affect people and the company itself, even though the news may have nothing to do with the company. Or you just don't raise enough money, and that's a big problem. So now that we know the advantages and disadvantages of a company going through an IPO, who's done a good job? LinkedIn did a great job. They raised all the money they went up to, they sold all the stock, and the price was $45 when they initially sold it. At the end of the day, it was 171% above that. And as well, Visa, their solid business plan allowed the IPO to go through really well. They raised a lot of money, and this is according to Edgar Online. A company that didn't do well with the IPO was Vonage. It lost 30% in the first week. Typically, the problem with IPOs when they struggle is that the company just has a bad business plan. You can't sell. You can't. They go to the market for the wrong reasons. They're trying to just either cash out, so the owners just cut and run. They don't care about the future of the company, or the company is going through the IPO to raise money to try and fix their business plan or to fix their problem. And sometimes just raising a lot of money doesn't help. So a big IPO to come is Facebook. It's valued at $100 billion. They could raise about $5 billion, which is a lot of money. And to review, now we know all about how IPOs happen, the advantages, disadvantages, and incentives that have come through the past. It's when a company sells its shares on the public market. It can allow for a lot of money to be raised, and sometimes the best business plans create IPOs, and the worst lead to fails. So the next time you'll raise a few million or even a few $1 billion, you just sell yourself on the street, Wall Street.